Dr. David Kelly, welcome to the Long-Term Investor.
So glad to be here.
Well, David, you put out some of the best work on markets, on the economy. It's something that everybody in the financial profession goes to anytime you're publishing. And I'm just kind of curious, we're in that season still where we're talking about forecasts. How does one go about making forecasts for the year?
Well, I approach this as an economist, and I've had a macroeconomic model of the U.S. economy, which I've been nursing and nurturing for the best part of 30 years. And so what I try to do is look at the overall mosaic of data. It's not any one series. It's not like the unemployment rate or GDP growth. I try to look at it all, actually. And I have forecasts for some key variables like GDP growth or unemployment or inflation or corporate profits. But they all sort of feed into each other. And so you sort of build a picture of how the economy is progressing. And I think it's very important to have that broad view, looking at a lot of numbers, because then you're not too surprised by any one number. And very often one surprising reading, say unemployment jumps up or falls sharply, it's not going to throw your forecast off that much. But it's really just working with a lot of data at the same time, because there's no series that's clean. There's no series that will tell you the full truth. And you just have to put it all together to try and get a picture of what's really going on.
And when you put your forecasts out into the world, I realize that's your job to do this, but how do you feel like people should be using these forecasts in general? Like, what purpose does the forecast serve?
Generally, it helps keep people grounded, to be honest, because if you watch news shows on TV or particularly anything on the internet, what they're trying to do is grab your attention by saying something crazy, and usually something crazy and negative. But that's usually not the truth. The truth is this is a kind of a boring economy. We're sort of in a post-cycle expansion. It's not like we're heading for a runaway or a soft landing. We've actually had a soft landing for some time now, but the economy is just sort of coasting along. But I think it's important for people to understand that and understand that we're not sort of on the edge of some economic cliff here, but also that people ought to really think carefully about the valuation of the stuff that they own, because what's happened is we've had this very steady economy, but you can get some assets which get to, push up to ridiculous prices by that. And so I think a lot of the risk is in markets, but not in the economy. And what I want people to do is just look at the economy in a balanced, non-political way and see it for what it is, but then also think a lot about where markets are given that economy.
There's something I cannot wait to dig into a little bit more. But before I do, I want to note to everybody watching, to everybody listening, that we're recording. The market is closed on January 30th. And so as we go through some of these conversations, we can't predict what's going to happen in the next 2 weeks that might change these. But I'm curious, David, there are a lot of potential policy changes that could impact a year like 2025. And before we get into those, I'm kind of curious, how do you feel like the economy in the market looks now? What is our starting point? And then what sort of considerations and adjustments do you think through as you're putting out forecasts and just thinking about markets?
Well, it's tricky. I mean, what you do is exactly that. You look at a baseline forecast of if nothing happened, if nothing changed in terms of policy, where would we be? And I remember last year in 2024, my forecast was actually 2024. 2% real GDP growth, 0 recessions, the inflation rate coming down to 2%, and the unemployment rate holding at about 4%. It turns out that was pretty close to the mark, actually. The economy is just a little bit stronger. Inflation was a little bit higher than that, but not by much. And honestly, the baseline forecast, if we didn't make any big policy changes, is 2024 for 2025. It seems like we'd have a repeat because the economy's got enough momentum in terms of things driving consumer spending to keep that going and therefore keep growth going at about 2%. There's no particular shock outside of what we do ourselves that we can see that would cause the economy to go into recession. I do think that inflation would gradually come down. We're seeing shelter inflation, auto insurance inflation gradually ease off. That should bring inflation down to about 2%. And in unemployment, we've got good job growth, but we've also still got good labor force growth. And those are offsetting each other, keeping the unemployment rate about 4%. So it would be 2024 for 2025 if there weren't any shocks or policy changes impacting the economy. But of course, that's really going to be the story of 2025.
Well, and so let's dive into maybe your viewpoints, or at least the framework for what you are thinking through as it comes to policy changes. And let's maybe start with what was supposed to be the sunsetting of the Tax Cuts and Jobs Acts, but generally most people would agree it's going to get extended in some manner. How are you thinking through that, particularly as you go through these different models?
Well, that's right. And I think I should preface this by saying that I really try to leave politics outside the door when it comes to investment decisions. I mean, people have got strong political opinions and will continue to have them. But when I look at policies from the new administration and the new Congress, I really look at those things which affect our culture and our lives and a lot of other stuff. And what are those things that really affect the economy and financial markets? And I focus on things that will affect the economy and financial markets. And that group is roughly the fiscal policy, which I'll talk about right now, which is the extension of the Tax Cut and Jobs Act of 2017 and any other tax cuts, but then also immigration, deregulation, and trade policy are all very important. But getting to your question on fiscal policy, I think we will first of all see a full extension of the tax cuts in the Tax Cut and Jobs Act, because if we didn't, you would actually be putting some fiscal drag on the economy in 2026. Now, yes, I think that, it does make the debt and the deficit worse. The deficit's already close to $2 trillion. I think even if we just extended the Tax Cut and Jobs Act in 2017, all those tax cuts, we'd stay at $2 trillion and slowly rise all the way to about $2.5 trillion in the middle of the next decade. So I think that's almost a given with a Republican control of the House and the Senate and the White House, that we'll see all those tax cuts extended. But over and beyond that, there were various promises that the president made on the campaign trail, removing the income tax from tips, overtime, and Social Security, cutting the corporate income tax rate for domestic production from 21% to 15%, putting in a new R&D tax credit, or allowing the full expensing of R&D and equipment purchases for domestic production, a tax break on auto purchases. If you add it up, it's a lot, and I don't think we're going to get it all. But I think you get some of it. The way this is going to work is there's one bill that's going to go through Congress this year. It's the Omnibus Reconciliation Bill for the 2026 budget. That is the vehicle upon which all of these tax cuts are going to have to be placed, because it's the only financial bill that can go through the Senate and not be blocked by a filibuster. You get one bite of this apple every year. And so that's what's going to happen. And over the course of the spring and the summer, people are going to be putting in their own pet tax cuts onto this bill. It will, therefore, I think, increase the debt. There'll be some efforts, some of them real, some of them not so real, to try to cut spending to pay for this, or to try to use perhaps tariff revenue to pay for some of this. But net, I think it will expand the deficit and amount to some fiscal stimulus in 2026 and beyond. So I think we will get bigger deficits, but also a stimulus to consumer spending, a stimulus perhaps to corporate profits, an increase in corporate profits, after-tax profits because of a tax cut. So it will basically be stimulative in 2026, adding a little bit to growth, but also adding a little bit to inflation.
You mentioned tariffs. I'm not sure that everybody totally understands how tariffs work, as well as what their impact can be on different economic participants. Yeah. And tariffs are really a big part of the campaign language this election season. Can you explain a little bit about how tariffs work and their impacts on different parts of the economy?
Yeah. So a tariff is an import tax. So you put a tax on imports coming into this country, and it's normally on goods rather than services, because that's just much easier. But all the goods that come into this country, if we put a tariff on those, the government raises a certain amount of revenue, but the prices that consumers pay for those goods, of course, goes up, and that adds to inflation. But also, when you put up those tariffs, people want to cut back on their spending on those goods because they can't afford to buy as much of them. So they tend to buy fewer goods. And sometimes over the long run, they will buy domestically made goods instead of the imported goods. And that as you get some domestic substitution, which also, further reduces our imports, of course, reducing also the tax revenue. That's how it works in sort of step one. But step two is you just put a tax on imports from other countries, they will put a retaliatory tax on you. And so then that's a real problem for our exporters, because suddenly they can't export as much stuff, or their goods are more expensive in foreign markets. The foreign consumers don't want to buy them. So they end up not being able to sell as much of the commodities and manufactured goods that they produce. And so the government may or may not provide subsidies to try and help them out. They certainly did under the first Trump administration, and that could cost some revenue. Meanwhile, you've got a higher cost to import, a higher cost to export, so trade diminishes overall, which tends to slow down the global economy. Economists don't like tariffs because in the long run, tariffs are it's a negative sum game. You get less trade, you get less economic growth, you get higher inflation, But also in the long run, it makes you less productive because sometimes it just does make sense to make something somewhere else. I mean, the dollar is too high. I will admit that. And I think we should do something about bringing down the value of the US dollar. But, are we really going to be manufacturing vast quantities of shirts and clothing here back in the United States? Or would it always be cheaper just to manufacture those overseas and import them and then use our labor to make more expensive items here and trade? Generally, countries flourish with strong trade and tend to stagnate if trade goes down. So I'm not in favor of tariffs, but that's roughly how they work.
Well, that's really a nice, clear, concise explanation. And again, this doesn't have to be political. This is just economics. This is just, what I was taught in school in general.
Well, yes. And there's general, I think that over the years, of course, we've seen a realignment of political parties in a funny way. But generally speaking, people who believe in free enterprise don't believe in tariffs. So it's usually there had been a consensus in this country that tariffs really weren't a very good idea. And now the consensus on both parties seem to be much more willing to embrace tariffs than was the case before.
Since the election, as the market is digesting some of these proposals, some of the promises that were made on the campaign trail, knowing full well that not everything gets implemented that's promised, but we've seen a pretty decent jump in long-term treasury yields. We've seen a jump in mortgage rates. I'm curious if you can share why you believe that this has happened and maybe how you might handicap long-term rates going forward.
Well, yeah. So if you think about and we haven't talked about deregulation yet, and we'll probably get to that. But if you think about the other policies, tariffs will tend to push up prices, cause you higher inflation. Fiscal stimulus in 2026 will also cause higher inflation. If you restrict immigration, and of course we have to see how this plays out, but if you were to shut the door on all immigration, for example, as a hypothetical, which is not going to happen, but if you shut the door on all immigration, we'd suddenly have a huge labor shortage because more than half of the jobs created in the United States in the last 4 years are now being occupied by people who were not born in this country. So if you have a huge labor shortage, you end up with higher wages. So all of it adds a little bit to inflation. Now, higher inflation pushes up long-term interest rates anyway. Because you're going to lend somebody some money and it's going to be, the money is going to be worth less when you receive it later. You need a higher interest rate. You need to get a higher yield. Higher inflation means higher yields. But it also sends a message to the Federal Reserve. If you go back to last September, the Federal Reserve thought they would cut interest rates 4 times this year. And now they're down to saying they're only going to cut interest rates 2 times this year. And indeed, if you listen to the January meeting from the Federal Open Market Committee, it's not even clear that they're intending to cut interest rates 2 times this year. They have to be cautious because if inflation's higher, they're not sure they should be easing monetary policy anymore. So it's both in terms of directly what inflation does to long-term interest rates and also indirectly because of what inflation means for Federal Reserve policy.
And you mentioned deregulation earlier. How does that play into all of this?
Well, deregulation can reduce inflation. For example, there's a lot of talk about deregulating energy. And so if you have fewer restrictions on energy production, you might end up with greater U.S. production of oil and natural gas, which will push down energy prices, which of course is disinflationary. There are perhaps other areas I think financial markets could benefit from deregulation if you, for example, reduce the regulation on banks making loans or how much capital they have to hold. You could get more economic growth, and that could possibly give you more growth and less inflation. So those things are positives from deregulation. But I think we need to pause and think a little bit about what deregulation means. So there's some things that aid financial markets. There's some things that might be good for the economy. But also, we're in a very weird time here in terms of technology. And you could argue that with completely new industries such as social media or AI, there's actually a need for not blanket, crude regulation, but actually rather intelligent regulation to try to limit the ability of these things to manipulate society in a way that's not a great idea or cause bubbles in markets. So everything that we regulate tends to reduce risk to some extent. If you deregulate, you may get more economic growth. You may also get lower inflation, but you also run the risk of a blow up. I mean, if you think about the crises that we've had so far in the 21st century, the housing crisis in 2008, the great financial crisis, was arguably caused by not enough regulation in the mortgage industry. You could argue that the pandemic had a lot to do with not being careful enough in terms of, obviously in this case, the Chinese, in terms of regulating their research into viruses. It was a catastrophic mistake. In 9/11, maybe, not regulating the people who are getting on board planes. I mean, if you think of every piece of this, in each case, you had sort of a failure of regulation. So there is a cost to a blanket deregulation, which I think we need to think about. We're probably not very good at regulating in a intelligent way, but every step in terms of deregulation can add to growth, maybe reduce inflation, but also may carry some risk with it.
I really like the way that you frame up the thoughtfulness with that. I think a lot of people sometimes digest those terms in very black and white manners, but the nuance and the shades of gray can make a big difference. Another topic that people really seem to treat with black and white vigor is the national debt. It's always a common question that I get in my inbox, that I get from families, friends, clients. How do you think investors ought to think about the U.S. national debt?
So I think for as long as I've been studying U.S. economics, people have been worried about the national debt and talking about it as being unsustainable. But of course, it's grown over these years and it has been sustained. And I think it's sustained because people like to invest in government securities and government bonds, and they trust the United States will pay its bills over time, and they can't think of a safer long-term investment. I think that's allowed us borrow a lot over time. But I do worry about the size of the deficits that we're running right now, close to $2 trillion. It's very hard to see how you bring them down in a significant way without major cuts to spending or major increases in taxes or both. And so I think most likely, given our political system, the debt will continue to rise for some time, maybe for years into the future. If at some stage it could cause a crisis, and that is, of course, very worrying, because if at any point global financial markets just believe that the US will not pay on its debts, you could have a big spike in interest rates and a big, a shudder or an earthquake for the global financial system. But for the moment, I think that day is still somewhat distant. But I think we have to think about, first of all, in terms of policy, so long as we maintain Federal Reserve independence, I think that's very important in terms of maintaining the credibility of the US federal government. And so long as we are somewhat careful in terms of how we extend the Tax Cut and Jobs Act of 2017 and don't allow just balloon deficits going forward, that gives us extra years in which to get our act together. So I think policy decisions made at this point are very important. In the end, I don't know what the percentage is. Right now, the debt is about 100% of GDP. It could well go to 130% of GDP 10 years from now. I don't know what that threshold is, but I do know that threshold, the location of that threshold depends on the trust people have in the US federal government. So maintaining our institutional integrity and the independence of the Federal Reserve and maintaining some semblance of an attempt to bring the budget into balance, I think those are all very important to put off the day in which the federal debt becomes a more serious problem. But even if we don't have a crisis, I do think that the level of federal debt, the amount of money the government has to borrow every year from global financial markets, probably will keep long-term interest rates higher. So, years ago after the great financial crisis, I think it was Mohammed El-Arian coined the very apt phrase that we were in a new normal. Well, we're back to the old normal in terms of higher long-term interest rates. And I think we will stay here. I think the new normal will not return because we just have got too much government debt and too much government borrowing to be able to borrow money that cheaply. I don't think we'll see those very low long-term interest rates again in our lifetimes.
Well, and does that have to be a bad thing?
No, I think I do think that you have to try and stabilize the debt at some level. So oddly enough, as the debt gets bigger, you can still run a bit of a deficit and the debt to GDP ratio can stabilize. So you don't need to get the deficit down to zero. I mean, the deficit is the amount that you're spending exceeds your taxes in every given year. You don't need to get that down to zero. If we could get that down to about 4 or 5% of GDP, then the debt to GDP ratio could stabilize and you could live with that. And there's nothing, that is, it's not perfect, but it's okay. What's a problem is if you run a deficit of 6 or 7 or 8% of GDP and you keep doing that, particularly in good times, it could lead to a financial crisis. It could also leave you much less well able to deal with a crisis if it occurs. And, we have seen economies where the central bank basically lost its independence, was printing money whenever the government said that they could print money. And it turns out very ugly. I mean, if you think about South American countries, it's sort of the road to Argentina when the central bank loses its independence. So it's very important to maintain that independence, to try and maintain stable inflation, and to have some level of discipline in terms of how big we allow these deficits get.
Well, and I'm going to continue to dig in here because I think it's just such a misunderstood topic in general. But as long as the Fed remains independent, the question is never really, can we pay our bills? It's more a question of, do we choose to? Because between the Fed and the Treasury, we can print the money necessary, to pay our bills. But if politicians, we still have this debt ceiling that's antiquated and not really relevant to the way markets work. But really, I think when rates rise, and please, tell me if you think differently, a lot of that, the fear of investors entrusting us, I think has more to do with, will our politicians make good choices? Will they choose to, honor their debts versus can we actually pay them? These are all dollar denominated debts. We can pay them. It's just a matter of how it happens. Is that a fair way to look at it?
No, that's absolutely correct. There are decisions that we make on taxation all the time. And for example, if you wanted to raise more money, you could do something on the step up in basis for capital gains or on estate tax or the higher levels of income tax, or you could try and do stuff on the supply side to say people, instead of being able to retire with full Social Security at 67, maybe you gradually edge that up to 70. None of these things are popular, but there are things that you could do on both the spending side and the tax side to balance the books. The problem, as you rightly say, it's a political problem. In the November elections, I saw an awful lot of commercials, far more commercials than I wanted to see. But I saw commercials attacking one side as being eager to raise your taxes and another side as eager to cut entitlements and to cut spending on Medicare and Medicaid. I didn't see anybody run a commercial saying, I'm going to cut the deficit by making tough choices and my opponent won't. Those ads were not run, and that's the problem. We decide, we vote against people because they're going to raise taxes or cut spending, but in fact, the only way to balance the budget will be to raise taxes and cut spending.
He's certainly not politically popular, and certainly something we're not going to solve overnight. It's a topic that I have no doubt will continue to be discussed on podcasts like these and in meetings and in social conversations. But a more timely, and maybe this will come and go over time, is the Magnificent Seven and the fact that it makes up such a large portion of United States markets. That has been something, I think, throughout 2024 that was brought to the forefront of a lot of headlines. It continues to be a talking point heading into 2025. What are your thoughts on the Magnificent Seven and the level of concentration within the S&P 500?
I'm going to have to check the old movie because as I remember, something like only one or two of the Magnificent Seven actually survived at the end of the movie. I have to think about that a little bit. I'm going to have to check that out. I worry about them. I'm not going to talk about individual stocks, but I do worry about the mega cap stocks as a group, because the assumptions you have to make about the ability of these companies to build a moat around their revenues going forward, to be able to justify the kind of price earnings multiples that they are commanding. I think you have to make some pretty outrageous assumptions for that. They can't all be magnificent. In other words, there may be a magnificent company among them. I'm not going to say which one, but they can't all be magnificent. And I think that's a problem. And I think we should also, as investors, we shouldn't assume that markets are rational about this. A lot of markets, and I think increasingly over time, work off the greater fool theory. I would use cryptocurrency as a perfect example of this. There is no value in Bitcoin at all. It's a completely worthless asset, which is used as a locus for speculation. But it is worth something because there is a greater fool who will pay you more for it down the road. That's why people buy it. And I admit that the supply of greater fools is pretty ample in the United States right now. It's like Federal Reserve reserves. It's beyond ample in terms of the supply of greater fools, but it is a danger. But when you look at that, I'm getting off on a sidetrack, but if you look at the speculation that you see in things like cryptocurrencies, or we've seen in NFTs, meme stocks, it sort of shakes your faith in the idea that there are just rational people coming up with the valuations of each of these Magnificent Seven stocks every day. So I think you've got to look very carefully at them. What's happened is, as we've had more and more people buying passive funds and index funds, as we've had a lot of liquidity sloshing around, people have paid less and less attention to fundamental analysis. So you put these companies on a spreadsheet, you put any prediction of their revenues, of their earnings going out on a spreadsheet. the valuations don't quite make sense, but that's not how markets work. But for investors, it's very important to think about that, because in the long run, valuations do matter in terms of total return. There'll be a break at some stage. We just don't know when that is.
Well, and there are a tremendous number of sophisticated do-it-yourself investors who I have emailing me, or people who are coming in the door to look for financial advice. So we get a chance to look at their portfolio, and really sophisticated people making a lot of the right decisions. And they are very overweight U.S. stocks, if not exclusively invested in the U.S. There's a lot of things that you mentioned related to valuation. You also mentioned earlier something about the dollar being overvalued. If you're speaking to somebody who is either intentionally or unintentionally wildly overweight to U.S. stocks, what are some of the things that you might tell them to think about on the risk side of things?
Yeah, I mean, I think the reason you diversify around the world is not just because you think the rest of the world might do better, but you're cautious about things always going right in the US. Something could go wrong here, and something could go wrong in mega cap tech, which is really leading the charge in the United States. So, for example, if you look at European equities, I mean, there's sort of the anti-tech index. They've got one or two big tech companies, and that's it. And it's really much more about a much more diversified index. It's boring. I think the European economy is growing slowly, not fast, but it's much cheaper, and it pays more than twice the dividend yield that the US equity market does. So I think it's worth having some money invested around the world, because something could go wrong. What's happened is, we've got this notion that there's a bull market in equities. But if we were sitting in Paris or in Dusseldorf, and we talked about the bull market in equities, they'd say, what bull market are you talking about? There's no bull market here. And there hasn't been for a long time, but that does mean that it means that their valuations are better. So, I think if you look at overseas markets, I can't tell you there's a huge catalyst right now, which is going to push the dollar down and cause those countries those regional equity indices to outperform. But what I will say is that their valuations look very good, and there's nothing wrong. They're throwing off good dividends. There's no reason why they shouldn't appreciate over time, give you a good total return. And after 2 great years in markets, and really, 5 out of the last or 6 years have been fabulous, people have accumulated a lot of wealth. And this is a good year to think about, okay, now let me not just think about how to grow this wealth in the long run, but let me think about how to preserve some of this too. So I would be diversified internationally. I am diversified internationally, not just because I think I'm going to get better returns in the long run from international equities, but I want to make sure that I'm protecting myself in case something goes wrong here.
Well, let me throw out an idea to you, and you tell me what you think of it. I mean, I look at the difference in returns for U.S. stocks and developed international, or even just global ex-U.S. And, there's 2 ways that a country can outperform. You can grow your fundamentals faster, more earnings, more cash flow, or people can, the price people are paying for those fundamentals can grow faster. And there has been a wild expansion in valuations in the U.S. relative to non-U.S.
Yep.
The fundamentals, I don't want to suggest that this, what I feel like is a secular bull market. I'm not suggesting that this isn't on the back of earnings, but I think the dramatic outperformance you can see has a lot to do with people are just willing to pay more and more and more. And at some point that seems like it would need to stop. What do you think about kind of my thinking there?
Well, I think that's right. And I think it's important to realize, that we have a chart in our guide to the markets, which shows that the US now represents 67% of global stock market capitalization. 67%. I mean, we're only 5% of the world's population. We are, or less than 5% of the world's population. We're, less than 25% of world GDP, but we're 67% of the global stock market. So that is obviously very high, but it's because we have a stock culture in this country. I mean, in Europe, people tend to invest in real estate or keep money market accounts, and companies tend to finance themselves through banks. We are the world's great stock market investors. It's not just that 67% of the world stock market capitalization is the United States. I would argue that 67% of the money that is going to be invested in stocks is here. So how Americans feel about the rest of the world and about America has an enormous impact on the fortunes of the global stock market. And I have to say that after years of the dollar going up and US stocks rising, there's nothing that American investors hate more than international stocks. I frequently speak at conferences where I talk to financial advisors and I ask them a simple question. How many of your clients would you say are overweight international? Absolute crickets. 0. Nobody is overweight international. But if investors hate international, it's very hard for international to perform well. And equally, if the US is infatuated with mega cap growth stocks, they will tend to outperform. And that's really what's been going on for many years. And it's sort of a self-perpetuating process until something goes wrong in the US and goes wrong with the dollar. It reverses for a while. And if you have a year or two in which the dollar has plunged and suddenly you're getting 20% in your international portfolio, but you're actually down in your US portfolio, people are saying, well, why again don't I own some international? And
that's right.
And that's what happens. But I would, I do think carefully about valuations matter in the long run, and international stocks are much, much less expensive than US stocks.
Boy, do I remember defending U.S. allocations coming out of the great financial crisis in the early 2010s. Nobody wanted to touch U.S. They only wanted emerging. They only wanted China. They only wanted anything non-U.S. And these things are cyclical. And what's interesting to me is that, yes, the U.S., we're all very proud of how innovative we are. And this week, again, there's a time lag between when we are recording and when this is being published. So now I'm going to really date myself a little here. But, a big challenger, foreign challenger to AI comes out of China. If you had told me that was going to come out of Europe, I would have been shocked. I just don't expect Europe to innovate the way that the United States or maybe some other economies are. But actually thinking about AI, that's the last topic I want to talk to you about, in terms of these big topics that people are talking about. What is it that you are excited about within AI? What are things that you think about as it pertains to your role in modeling out the economy as it comes to AI? Anything that's on your mind there?
Well, there are a few things. I mean, first of all, I think there is a lot of potential and a lot of risk in AI for the economy and for our society overall. I do think that AI is completely real, and it's going to be a growing part of everybody's lives for years to come. What's happening is, obviously, we've got these AI models, these AI chips. The AI is able to do more and more, but it is literally an evolving technology, and it is getting better all the time. And every generation is smarter than the last generation, and therefore it could do more work. And because it can do more work, over time, there's going to be more investment into it. So you end up with this exponential process where you've got more capital spending on smarter and smarter technology. You can then, if you integrate it properly with robotics, there is more and more labor you can replace with it. That can make the whole economy more efficient in terms of output per labor hour, although it can have huge distributional effects on the people who lose employment because of it. I'm not that scared in the long run that we're going to have mass unemployment because of a technology. That has never happened in the past. Usually technologies lead to just new jobs and new ideas coming up. So it could, that's a positive side. The negative side is that unregulated, some of these technologies can have very detrimental effects. There's a lot of research now coming out on the effect of smartphones on young brains. And it is really affecting society. I don't think just young brains, I think brains in general. If AI means, I have arguments with people in my team all the time who want to use AI to proof their work. And no, you won't do that. I don't want people who can't write because AI could write for them. And the more we disable ourselves, people can't write cursive anymore. If we say people can't type anymore because they can just talk it all, or if they don't have to think about how they say something, because the computer will do it for them, then you will lose some human intelligence that way. I think that's a risk. And then also AI in the hands of nefarious characters could do terrible damage, political damage. It could, potentially you could have, without regulation, you could have the equivalent of a lab leak in AI, or a nefarious character doing something with AI technology, which has very damaging effects on society. So, I think AI plus robotics has got tremendous potential. AI plus oligarchs has got potential risk. I think it's going to happen anyway. And so what I hope we do is really think urgently about the need to regulate AI so that it is used for the good of mankind and not for the detriment of mankind. And if we don't regulate, very likely bad things will happen eventually. With regard to investing, though, the key thing I'd say is, look, it's real, but you don't know who the winners are going to be. The dot-com boom of the 1990s, which we now call the dot-com bubble, it was real, and it really was a boom. It's just that 90% of the companies that flourished under that, was sunk beneath the waves because they weren't actually making money from it, and the few that survived and really thrived and changed the world. That's probably the case with AI too. And we really don't know how it's going to work, because as everybody invests in this, suddenly if you find, oh wait, we don't need the services of company X at all because we can do it. We can do this quick end run around them. Then suddenly, the stock of X collapses. So I'd say it's worth making a broad bet on AI capital spending, on companies that'll be able to benefit from it. I think you have to keep pay very close attention to that and be very diversified across all the effects that AI will have in the economy. There will be money made in it, but there are going to be more losers than winners among companies. So don't just bet on a company that's got an AI theme and assume that it's going to win. You need to have a diversified approach to AI.
David, it is always a pleasure hearing your thoughts. It is a true honor to have you directly on the show. In the show notes at thelongterminvestor.com, I'm going to put links to Guide to the Market, to your podcast. What other places should people be looking to find more and follow along with your insights?
Well, thank you. I mean, we do have, we update our Guide to the Markets every day by 10 a.m. And also I write an article on LinkedIn. You can sign up for that. So if you want a written version of my notes of the week ahead. And then, we do lots of webcasts too. So you can, if you are interested in that we just check out our advertising, because we will talk a lot about, we will advertise our various ways we try to update people on what's going on and what it means for investors.
Well, again, thank you so much for your time. And again, if you're watching or listening to us, go to thelongterminvestor.com. You will find all of that information. You can follow along with David's great insights. Thanks, everybody. Until next time, to long-term investing.